Sunil Garg, the head of global research at JPM, joins us on the phone line from Hong Kong. Good morning, Sunil. Thank you very much for joining us at what should be a busy hour for you. How are you looking at this big risk aversion wave that is sweeping? Is this going to last for quite some time because you're getting now fresh doubts over global growth? Or will you just say this is year-end profit-taking and maybe a little ugly, but it will pass quickly?
Hi. So look, there is definitely some concerns which especially lower commodity prices are raising, whether this is weaker demand conditions. Our own view is that, yes, growth is disappointed in 2014, slightly, modestly, a little bit below expectations. But we're still looking at GDP growth to rebound from 2.5% to 3% next year. This is global growth with the U.S. showing a rebound and economies within Asia like India showing a rebound as well. So we're not bearish on growth. We do think that markets certainly in some places had gone ahead of expectations, so there's definitely a period of consolidation. And I think in key markets there will be buying opportunities which this correction is providing. It may not be today, but we do think that it's probably premature to be bearish on growth outlook overall.
Sunil, hi, morning. That's an optimistic view that we're starting our morning with. So you don't expect any flight of capital out of emerging market funds, including India funds, at least in the first part of 2015?
See, as I said, tactically, today may not be the day to buy. I do think that, there is a period of correction and consolidation that we will foresee in the short term. So I do think this will provide a buying opportunity. It's just not there as yet today. So there is some concerns on growth, no doubt. There is clearly deflationary questions being posed, which lower commodity prices are imposing. So we're seeing that across the board, not just in emerging markets, but also in developed markets. We've seen Japan correct quite aggressively over the last few days. We've seen the U.S. markets correct. We've seen the European markets correct. So I don't think this is necessarily limited to emerging markets, but I think it's a much more broad-based concern overall in the short term in the markets. But as I said, we're not bearish on growth outlook at this point in time. And in India in particular, I do think that we've seen the market run very well ahead of the actual delivery on earnings, and no doubt monetary policy headroom is getting created as inflation comes off. WPI printed 0 yesterday. So we should be looking at opportunities to buy, and I think there are some areas which are attractive even today on a relative basis, but a period of correction is not ruled out at this point.
Okay. For the better part of 2014, India was the best performing market, but in the last 8 weeks, we saw fairly decent outperformance coming from China. How do you see the next 6 months, which may be the leaders in the emerging markets in terms of performance?
See, if you look at the BRIC countries, we are overweight in China and India, and we are underweight in Brazil and Russia. So I guess the alignment is very much towards the Asian emerging markets in many respects. I think in the Chinese market, you have to look at the outperformance and the absolute rally in the context of a very, very long and deep underperformance over the last 4 years or so. So we do think that China has more legs to run. I think one of the defining features we're seeing across emerging markets, with the exception of Brazil and Russia, is the monetary policy cycle seems to have turned. And we're expecting rate cuts in India. We're expecting some more monetary easing in China. So I do think that there's room to run further up in places like China.
Right now, of course, we have moved off a goodish bit from that 8630 high that the Nifty notched up for itself. How much more downsides you think in this current wave of profit taking?
Okay, don't want to get pinned down into a specific index target on the Nifty, but as I said, I think there are areas of the market which I would look to buy today for outperformance, but I do expect the market overall to be correcting. I think the one area which you want to be playing with, especially monetary easing, more likely than not, would be banks, and particularly PSU banks. I think the PSU bank trade has been outperforming, and I think this one looks, I think, one of the best opportunities in the market.
Can you throw some more light on what your sectoral bent is apart from PSU banks? Because, as of this morning itself, we have positive news that the RBI has eased some norms on infrastructure loans, etc. How are you watching some of these economy-related pockets like infrastructure, capital goods? Is it still a good place to put money into?
See, from a valuation perspective, the deep cyclicals are definitely, and overall the cyclical space is still very attractive. I think rather than look at a broad-based buying in that space, I think one area you want to be very careful on is companies that have the ability to deleverage, because I think one of the biggest problems we saw in this space in the last few years is companies' balance sheets had become leveraged up to a point where it was becoming unsustainable. So even though you get monetary easing or easier availability of funds, you still need some of these companies to deleverage. And I think even within the infra space, there is quite a bit of dispersion. So I think the pointer I would use is where companies have shown a demonstrable capability to deleverage.
Okay.
Or as I said, PSU banks become a levered play on the same opportunity, just a much cleaner, easier opportunity to play on the upside.
All right, just one final question then from our end. We've got an ugly trade deficit number to react to this morning. But within that, the biggest disappointment is that exports have fallen quite a bit. How do you react to some of these export-linked companies in the Indian market? Would you stay away, or would it be a good time to buy if any dip?
Look, again, there can be a fair amount of noise in the monthly trade data, so I wouldn't necessarily read too much into it. I think your previous commentator was talking about a weaker currency, and I think, Lata, you were talking about the rupee hitting 63. So definitely we've seen the currency depreciate slightly, so it does help the export companies. But then just bear in mind that we've seen a very substantial performance from some of the export-driven companies, particularly the IT services. So just keep that context in mind as well. And I keep defaulting back to playing the domestic story much better, which is contingent on early cycle recovery, monetary easing, and that is the place where I think the biggest upside and opportunity exists.
Well, we want to hear more of the good thing, I guess. So that's why this last question. The GST is almost about to be through, maybe not in the best of shapes, but still that amendment bill looks like will be placed before Parliament in a week or so. Will that be seen by investors as very big?
It's a step in the right direction, because at the end of the day, I think this has been talked about for quite some time. And I think it does help bridge the fiscal gap to some extent. And I think from that perspective, it will be seen as fiscal consolidation. And given that the inflationary forces are now a little bit behind us, or at least definitely eased off, I think it's at least from an inflationary perspective, won't be a problem, or at least shouldn't be as much of a problem. So yes, it should be seen as a positive.
All right. Thank you very much, Sunil, for finding time for us and an unscheduled time slot at that. Thank you very much.